This is Matthew Cratter from Trade University, and today I want to talk a little bit about why the stock market is crashing, how this is related to markets worldwide, and I'm calling this stock market tsunami hits for reasons that you're going to see shortly. I've been warning for over a month that we've entered a global financial crisis, and things are really beginning to get serious. What happens in a financial crisis is you get correlations going to one. Everything starts moving together, especially crashing together. And as we're going to see today in this video, a butterfly flapping its wings in Japan could cause a market tsunami in the US. If you've been watching stocks, if you've been watching the NASDAQ breakdown, you're going to want to definitely watch this video all the way to the end so you can see how interconnected we all are, especially through financial markets. So what we've had is we've basically had a decade of pretty dumb US and EU energy policies. I'm not really going to go into this, but the end result, combined with the invasion of Ukraine by Russia, has meant a large spike, obviously, in energy prices, oil, crude oil, natural gas, as well as food prices. And we're going to see what this happens. This is obviously bad for developing countries, and it's even bad for developed countries that are highly dependent on imports of food and energy. So Japan imports a lot of energy and food, and as a result, when the price of oil and food and other energy prices starts going up, it starts running a larger trade deficit. That just means the country is importing more goods and services than it exports. And Japan is very dependent on external sources, especially for its energy. When the yen is weaker, the Japanese yen is weaker, as we're going to see, it also continues to push up energy prices and increase the deficit because energy prices go up in yen terms. I'm going to explain that in a little more detail in a minute. So Japan just recently reported a huge trade deficit, 412 billion yen in March. This compares to actually a small trade surplus a year ago. So this is a very big change. Japan is also running what's called a budget deficit, where the government is spending more than it brings in taxes. The US is doing something very similar. We have a trade deficit and we also have a budget deficit. When you have both of these, when you have a budget deficit and a trade deficit, well, you'll often hear this phrase, twin deficits. What this means is that you become much more dependent on foreign financing of your government bonds. That is, unless you want to get your central bank involved. And they usually have to end up being involved, as we're going to see as we work through this video. So the fact that Japan is now running a higher trade deficit because energy and food import prices have gone up, what this means is that Japanese government bond yields are rising as the markets anticipate the need for more foreign funding of the Japanese government. You'll often hear this phrase, JGBs. It just stands for Japanese government bonds. And the interest rates, the yields on these government bonds have been rising, just as US Treasury yields have been rising as well. Now, the dangerous thing about this in Japan is that debt levels are so high that rising yields risk bankrupting the government. The higher yields go, the more difficult it can become for the government to finance itself. And again, it needs to finance itself because it has a budget deficit. It's not bringing in enough in taxes to cover all of the government spending. If you're finding this video helpful so far, be sure to hit that subscribe and like button. Maybe share this video with a few friends as well so they can become familiar with the Trade University channel. So we said that Japan has very high debt levels. I want to put that in perspective. The US currently has debt to GDP. So in other words, we're measuring public debt, government debt, as a percentage of the productive capacity of the economy, which we're using GDP as a proxy for here. Debt to GDP in the US is something like 122, 123%, which we can see is higher than it's ever been, really since the end of World War II. But the debt to GDP situation in Japan is much, much more extreme. This is an old number, but as of 2020, their debt to GDP, it's even higher now. Their debt to GDP was 266% as compared to our 123%. This is a very highly levered economy. Now, what happens when yields rise? When they rise too much and they risk bankrupting a government? What happens is a central bank, in this case the Bank of Japan, prints up some new money, prints up yen, Japanese yen. The abbreviation for that is JPY. You'll often see it. Prints up money and buys government debt in order to cap yields. And so this is what we saw last week. The Bank of Japan, the central bank in Japan, offered to buy an unlimited amount of 10-year government JGBs, the 10-year government bonds. They offered to buy an unlimited amount. And what they were doing here is they were defending the yield on those bonds. They were doing what's called yield curve control. So we can see here that Japanese government bonds, they trade at very, very low yields, whereas the U.S. Government bonds are somewhere in the 2%, 2 to 3% range right now, depending what maturity. The 10-year notes, the 10-year government bonds in Japan yield 0.25 percentage point or 25 basis points. And what's been happening here is the Bank of Japan, we can see this green line, which is approximately at 0.25%. Again, that's 0.25 percentage point or 25 basis points, 25 bips. They've been buying government bonds in order to hold those yields down so that the government doesn't go bankrupt and individuals who have borrowed a lot of money or corporations don't go bankrupt as well if they're highly leveraged. So this is yield curve control. We've been talking about this for a few years now, but we're actually seeing it happen in real time in Japan. They've been doing it on and off for the last 20 years or so, but they've really had to step it up in the last week. And this has huge implications for the U.S. stock market and other markets, as we are going to see. YCC just stands for yield curve control. And what it involves is basically a central bank will print up money ex nihilo out of nothing and buy government bonds with it in order to keep yields lower than they otherwise would have been. Now, this sounds like a free lunch, but there's no free lunch in economics or anywhere else. There's certainly no free lunch when it comes to resources and energy as well. And there's no free lunch when it comes to money. If you try to manipulate interest rates, you end up blowing up the currency. The currency and the exchange rate becomes the escape valve. So what we've been seeing here, we have a chart here of USD JPY. This is the dollar, US dollar versus the yen. When the chart moves up, that means the US dollar is strengthening relative to the yen. When the chart moves down, it means the yen is strengthening against the dollar. We can see in the past week, we've had just tremendous US dollar strength against the yen. And we breached 125, which is a key level. And there have been a lot of Japanese officials and ex-government officials saying if we get up to 130 here, the government's really, the Japanese government and the Japanese central bank, the Bank of Japan, are really going to start to panic. So what's happening is the Bank of Japan is printing up all this money. And because the U.S. is not printing up as much, the yen is weakening against the U.S. dollar, at least for now. Again, the Bank of Japan is doing this, trying to defend, trying to keep government bond yields below 0.25%. But in the process, they're blowing up the yen. And to put into perspective how severe this is the longest losing streak that the yen has experienced against the dollar in over 50 years. This is an article that's a couple days old, so it's gotten even worse since this article was published on April 18th. Now, what happens when the yen weakens against the U.S. dollar? And again, this is the chart we're seeing, the yen's massively weakening against the U.S. dollar. Well, what happens is it makes energy prices more expensive in yen terms, since energy, crude oil, natural gas, is still priced primarily in U.S. dollars. So what happens? You get the money printing from the Bank of Japan. They're printing up more yen, and it ends up, by weakening the yen against the dollar, it ends up increasing food and energy costs for Japan, simply because they need dollars to buy energy, and they can purchase fewer dollars since the yen is weakening. What this means is they're paying more for food and energy imports. This further increases the size of the trade deficit because it's now become more expensive, as we said, to import energy and food now that the yen is weakened against the dollar. And so what happens? We're back to where we started. When you have a higher trade deficit, that makes the market price in higher interest rates, higher JGB rates, which means that the Bank of Japan needs to do even more yield curve control, try to keep those interest rates down. And money printing, which again weakens the yen, causes energy prices to go up even more. And so you can have what people call a doom loop, or a vicious spiral, vicious circle, or vicious cycle happening here. And it's hard to know exactly what is going to happen. what Japan is going to do and how it's going to be able to exit from this policy doom loop. Now, why is this important for U.S. markets and global markets? Well, it's important because Japan is currently the largest holder of U.S. Treasuries, of U.S. government bonds, and I think they're still the largest marginal buyer as well. They hold more U.S. Treasuries than even China does. Now, why is this important for the U.S. stock market? Well, what happens is when the yen weakens, it can change the hedging costs for Japanese investors and institutions that are buying U.S. Treasuries, even central banks that are buying, the Bank of Japan buying U.S. Treasuries. And the way it works is this. If you're in Japan and you want to buy U.S. Treasuries, U.S. government bonds, you basically need to sell some yen, buy U.S. dollars with it, because you can only pay for U.S. Treasuries with U.S. dollars. So you do the conversion. You buy U.S. Treasuries with that U.S. dollar, and then you hedge the currency risk. So let's say you're buying a 2-year government bond, a 2-year Treasury note from the U.S. You hedge the currency risk of that position by entering into a forward agreement to swap U.S. dollars for yen. So to swap back into yen in the future when those U.S. Treasuries mature, in this case in 2 years from now. So what happens is if those hedging costs, those currency hedging costs are higher because the yen has been depreciating and the market is pricing in more yen depreciation, what this means is that the hedging costs go up and it becomes much less profitable for traders and investors to buy U.S. Treasuries from Japan. We can see here an analyst at Wells Fargo estimated that Japanese investors will now have to pay 2.17 percentage points to hedge the yen against the dollar over 12 months, up 1.42 percentage points this year. And the article goes on to make the great point, which I'm making, that could pose a problem for the Fed with demand from foreign investors for U.S. assets going down because of this. So basically, higher hedging costs means that Japanese investors will buy fewer U.S. Treasuries. Fewer buyers of U.S. Treasuries means U.S. Treasury yields will keep spiking until someone steps in, and that someone is going to have to be the Fed. Until they do it, we're going to have these various doom loops moving around, and as interest rates move up, it continues to cause stocks to go down. And as such, we're subject to a lot of black swans here. We're subject to sudden market moves. I'm expecting Bitcoin to go down to 30,000. I think we get stocks continuing to move lower because it doesn't look like the Fed is ready to step in yet. But there's this fundamental problem where ever since the U.S. sanctioned and confiscated Russian currency reserves, the U.S. Treasuries are no longer seen as this pristine reserve asset. So in addition to Japanese investors not wanting to buy more U.S. Treasuries because of this change in the exchange rate and the forward hedging costs, in addition, you have reduced demand for U.S. Treasuries from Russia. Russia actually stopped buying them a few years ago, but also from China, from Saudi Arabia, from all these countries who are looking at what happened to Russia and thinking to themselves, why would I ever want to own U.S. Treasuries, especially holding them in a foreign bank or a foreign central bank, if they can just be confiscated by the U.S. if the U.S. gets mad at us. So what this does is it creates less global demand for U.S. Treasuries. We already saw how there's less Japanese demand. And this is why I'm calling it the tsunami hitting U.S. markets, where all these markets are highly interconnected. And what happens in politics, what happens in policy, what happens in currencies can have huge effects on interest rates, can have huge effects on risk assets like stocks and Bitcoin. Eventually, the Fed is going to need to step in and print money and fix all the damage that they have caused and stop this doom loop. Otherwise, we are going to have a major financial crisis. We could end up with a depression. Hopefully, the Fed will not let it get that far. But in the meantime, I thought I would show you how this works, how the markets are so interconnected, and what happens when you begin to get these doom loops going and you get global contagion. So prepare for more rough times ahead. I'm obviously haven't sold any of my Bitcoin, still holding 100% of it, and I'll be buying more on the way down. I continue to dollar cost average, and I have some limit orders in at 35,000, 30,000, 25,000, and 20,000 to hopefully be able to pick up some Bitcoin at those lower levels, because when the Fed comes back in, when this whole thing reverses, it's going to be extremely violent, And you're going to see stocks go to new highs. You're going to see gold go to new highs. And most importantly, you're going to see Bitcoin go to new highs. This is easily how Bitcoin gets to 200,000, 300,000, 400,000. Whenever the Fed reverses course, it's probably not going to be next month. Could be 3 months from now. Could be 6 months from now. Just a question of how much pain politicians and central bankers are willing to take. And they've certainly created a completely messed up system here. I hope this shows you how bizarre the current financial system is. And this is why my hope is that we're eventually on our way to a Bitcoin standard where we don't have these crazy dynamics with competitive devaluations from central banks, etc. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.